Imagine you're standing in the middle of a busy street market. All around you, people are talking about how things are falling apart. Some are walking away. A few are saying the whole market is about to collapse. And then, quietly, off to the side, the wealthiest and most powerful institutions in the world are loading up carts. Not one cart, not 10, but the equivalent of $37 billion worth of a single asset in just 3 months. That should make you stop and ask one question: who's actually right here? That is exactly what we're going to unpack today. Because right now, there is a massive, almost surreal gap between what everyday investors are saying about gold and what the world's central banks are actually doing with their money. And understanding that gap might be one of the most important financial awareness moments of this entire year. So let's set the scene. If you've spent any time on social media, in financial forums, or watching the news lately, you've probably picked up on a certain mood, a sense of worry, a feeling that markets are shaky, that inflation is still a problem, that the economy might be heading somewhere uncomfortable. And a lot of everyday investors have been responding to that mood by pulling back, being cautious, waiting on the sidelines. The overall tone, if you measured it, is what analysts call bearish, pessimistic. Stay away. And gold has been caught right in the middle of that sentiment storm. Social media has been full of people questioning whether gold's recent moves are sustainable, whether it's overpriced, whether the rally is already done. There's a whole narrative spreading that says the smart move is to be cautious about gold right now. But here's the thing. While that narrative was spreading across comment sections and financial forums, the central banks of the world were doing something very different. According to data from the World Gold Council, central banks collectively purchased gold worth approximately $37 billion in the first quarter of 2026 alone. Let that land for a second. $37 billion. In one quarter, that is not a small number. That is a record-breaking number. That is the kind of number that doesn't happen by accident. Before we go further, let's make sure we're all on the same page about what a central bank actually is and why their decisions matter so much. A central bank is essentially the bank that backs all other banks in a country. In the United States, that's the Federal Reserve. In Europe, it's the European Central Bank. In China, it's the People's Bank of China. These institutions manage a country's money supply, hold massive reserves of assets, and guide entire national economies. When a central bank makes a move, it is not done on a whim. It is not emotional. It is not based on a viral post or a hot take. These institutions have entire research departments, thousands of economists, and decades of institutional knowledge behind every single decision. So when you see $37 billion flowing into gold from central banks in a single quarter, you have to ask, what do they know? What are they seeing? And why are they moving so decisively when so many everyday investors are standing still or even moving the other direction? Let's break this down, because this is where it gets really interesting. First, we need to understand what gold actually represents to a central bank. For most of us, gold is an investment, something we buy when we think prices will go up, or when we're worried about inflation. But for a central bank, gold is something fundamentally different. Gold is a reserve asset. It is the foundational layer of financial stability. It has no counterparty risk, meaning unlike bonds, stocks, or even currencies, gold doesn't depend on another institution's ability to pay up. Physical gold in a vault is nobody's liability. It just exists, and that quality makes it uniquely valuable in an uncertain world. Now here's what makes the current moment so significant. Over the past 3 to 4 years, we've seen a dramatic shift in the way central banks think about their reserve holdings. For decades, the U.S. dollar was the unquestioned king of global reserves. Countries held their savings in dollars and U.S. Treasury bonds because it was safe, stable, and universally accepted. But something changed. The freezing of Russian central bank assets in 2022 sent a signal to central banks around the world: holding too much of your reserves in any one currency, especially one controlled by another country, carries real risk. Concrete, this can happen to us, risk. And so, quietly and methodically, central banks started diversifying. They started buying gold. not in dramatic announcements, not in press conferences, just steadily, consistently, quarter after quarter. And what we're seeing in Q1 of 2026 is that trend not just continuing, it's accelerating. Think about it this way. If you found out that the most careful, most well-resourced, most long-term oriented financial institutions on the planet were quietly but aggressively buying one particular asset, and they had been doing so for 2 straight years, and now they just had their biggest quarter ever, would you at least want to understand why? That's the core of what this video is about. Not to tell you what to buy or sell, but to help you see a signal that a lot of everyday investors are completely missing because the noise around them is too loud. Now let's talk about the retail side of this story because the contrast is genuinely fascinating. If you look at retail investor sentiment around gold in Q1 2026, you see something almost opposite to what central banks are doing. Surveys of everyday investors show elevated skepticism. Outflows from retail-facing gold ETFs have been notable. Social media sentiment leans toward caution and doubt. Some of this is understandable. Gold had a strong run in 2025, and after any asset moves significantly higher, people naturally wonder if it's gotten ahead of itself. That's a normal psychological response. But what's driving the bearish mood among retail investors isn't just price fatigue. It's also the broader economic confusion of the moment. Interest rates are still elevated. The stock market has been volatile. Crypto has had its own drama. Inflation numbers have been mixed. And in that kind of environment, a lot of investors default to wait and see. They don't want to make the wrong move, so they do nothing. Or they follow the loudest voices, which right now are leaning bearish. Here's what this means for the big picture. You have a divergence. One of the most significant divergences in recent financial history between institutional behavior and retail sentiment. The smart money is going one direction. The crowd is going another. Now, divergences like this don't always resolve in favor of the institutions. Markets are complicated. Sometimes the crowd is right. But historically, when central banks consistently accumulate an asset over an extended period, that carries serious weight. Here's a great moment to hit that like button and subscribe if you haven't already. We cover topics like this regularly. Things that don't always make headlines but genuinely matter for how you think about your money. Always free, always here. Okay, back to it. Let's go deeper on the mid-cycle consolidation idea, because this is one of the most important concepts for understanding what might be happening right now. A market cycle typically goes through a few broad phases. There's the early phase when something is starting to move and most people haven't noticed yet. There's the mid-cycle phase when the asset has already made a significant move. Some early investors are taking profits, new money is hesitant, and the price can feel stagnant or even pull back a bit. And then there's the later phase when broader awareness builds, more participants pile in, and the asset often makes its most dramatic moves before eventually cooling off. A lot of the bearish sentiment around gold right now looks like classic mid-cycle behavior. Gold had a massive run. Some people who bought early took profits. Others felt like they missed it. Media coverage got noisy, and so a collective uncertainty set in, this feeling of, is it too late? Did I miss it? Should I wait? But here's what central banks don't do. They don't sit on the sidelines because they're worried they missed the beginning of a move. They don't react to social media. They don't care if the short-term chart looks messy. What they care about is the long-term thesis. And the long-term thesis for gold right now, based on geopolitical shifts, dollar reserve diversification, and persistent inflation pressures, appears to be very much intact in the eyes of the people managing the largest pools of capital on the planet. Mid-cycle consolidations can feel uncomfortable. They can feel like the trade is over. But often, they're exactly the point where the longer-term story is being quietly reinforced, while less patient money exits and more patient money enters. Now there are real risks to this picture, and we should be honest about them. If inflation drops dramatically and central banks pivot to aggressive rate cuts, some of gold's appeal could diminish in the short term. If the global geopolitical environment suddenly becomes more stable, the reserve diversification thesis could slow. If a strong economic recovery sends investor confidence into equities, money might flow away from gold. These are all legitimate possibilities. Anyone who tells you an outcome is guaranteed is not being straight with you. But here's where we separate signal from noise. What would have to be true for the world's central banks to suddenly reverse course? For them to collectively decide that the thesis they've been building for 2 years, the thesis that led to record purchases in Q1 2026, is wrong. That is a very high bar. That's not a bar that gets cleared by a single bad inflation report or a few weeks of market volatility. That kind of institutional conviction takes something significant to unwind. So let's talk about what this means practically, not as financial advice, but as a thinking framework. The first thing to internalize is the difference between sentiment and flow. Sentiment is how people feel about something. Flow is what people actually do with their money. When these two things diverge significantly, it's worth paying attention. Right now, sentiment among retail investors around gold is bearish, but the flow of actual capital from the most powerful financial institutions in the world is strongly bullish. $37 billion worth of bullish. Understanding that difference helps you cut through the noise. The second thing is to think about time horizons. A lot of the bearish chatter online is focused on very short time frames. What happened this week? What might happen next month? Central banks are not thinking in weeks or months. They are thinking in years and decades. Their purchases in Q1 2026 are not a bet on where gold will be in July. They are a bet on where the global financial system is heading over the next 5 to 10 years. When you adjust your time horizon, the picture looks very different. The third thing, subtle but important, is to recognize the asymmetry in information. Central banks have access to economic data, geopolitical intelligence, and institutional research that most everyday investors will never see. That doesn't mean they're always right. But it does mean that when they move with this kind of conviction and this kind of scale, it's worth taking seriously. Not blindly, but seriously. Now let's connect this to something really concrete: your life, your savings, your financial thinking. If you're an everyday investor, someone with a job, a family, maybe a retirement account, maybe some money set aside for the future, you're probably not in a position to act like a central bank. You can't buy $37 billion of anything, but what you can do is understand the landscape. What you can do is recognize when a major signal is being overlooked by the crowd. What you can do is ask the right questions when everyone around you seems to be going one direction without really understanding why. Think about it this way. If you found out that every professional chef, food critic, and restaurant owner in your city was quietly lining up around the back of a local bakery every morning, while everyone on the main street was saying that bakery had gone downhill, you'd at least want to taste the bread before making up your mind, right? That's the situation we're in with gold right now. The comment section has a very different view than the people placing the biggest orders. There's also a broader story worth understanding here, one about the changing shape of the global financial system. We are living through a genuinely historic moment of transition. The post-World War II financial order, built on dollar dominance and stable global alliances, is being tested in ways it hasn't been tested in decades. New economic blocs are forming. Countries that once held the vast majority of their reserves in dollars are diversifying, not because they're anti-American, but because they're pro-stability. And in that environment, gold plays a very specific and very valuable role. Gold is neutral. It belongs to no country. It carries no political baggage. It cannot be sanctioned. It cannot be devalued by a foreign government's monetary policy. In a world where financial trust between nations is being recalibrated, gold is the one asset that everyone can agree on. That's not a fringe idea. That is the explicit, documented reasoning that central banks from Poland to India to China to Brazil have given for increasing their gold holdings. The $37 billion number is not a mystery. It's a response to a very real and very visible shift in the global order. And yet most everyday investors are not looking at that level. They're looking at the short-term chart. They're reacting to the latest headline. And that's completely understandable. We're all processing a lot of information, and it's hard to zoom out when every day brings new noise. But that's exactly why understanding signals like this one matters. The ability to separate what's loud from what's important is maybe the most valuable skill an investor can develop. The things that make the most noise are not always the things that matter most, and the things that matter most don't always announce themselves loudly. So where does this go from here? Let's think through a few scenarios honestly. In one scenario, the central bank thesis plays out over the next several years. Geopolitical tensions persist. Dollar reserve diversification continues. Inflation stays stickier than expected. Gold continues serving as a core reserve asset, and its price reflects sustained institutional demand. Retail investors who were bearish during the mid-cycle consolidation eventually come around. Some too late, some at reasonable points. This is a plausible scenario aligned with current data. In another scenario, some of the risk factors materialize. Inflation drops sharply. Global stability improves. Central banks slow their purchasing pace. Gold pulls back or trades sideways for an extended period. Those who were bearish in Q1 2026 might look right in the short term. This is equally plausible, and any honest analysis has to acknowledge it. And then there's the murkier middle, where things don't move cleanly in either direction. Gold grinds along with volatility, central banks continue buying at a slower pace, and the picture stays ambiguous longer than anyone is comfortable with. Markets have a way of frustrating both bulls and bears. No video, no analyst, no institution can tell you with certainty what happens next. What we can do is lay out the information clearly so you can form your own informed view. And the most important piece of that picture right now is the one being drowned out by the noise. $37 billion one quarter, central banks, gold. Let's pull the key ideas together as we wrap up. Central banks around the world bought gold at a record pace in Q1 2026, approaching $37 billion. This reflects a deliberate, long-running institutional shift toward gold in a world where geopolitical uncertainty and dollar reserve concentration are driving a massive global rebalancing. These institutions are not emotional. They are not reacting to headlines. They are executing on a long-term strategic thesis. At the same time, retail investor sentiment around gold has been cautious to bearish. Social media chatter, short-term price concerns, and economic confusion have created a narrative of doubt, a sense that the smart move might be to wait or stay away. The gap between what's being said and what's actually being done with capital at the institutional level is one of the most significant disconnects in financial markets right now. It doesn't guarantee any outcome, but it is a signal, a clear, data-backed signal that deserves to be understood. Mid-cycle consolidations are uncomfortable. They test conviction. They often look from the outside like the beginning of a reversal. But sometimes they are exactly what they appear to be when you look at the flows rather than the feelings. A pause before the next chapter of a bigger story. Whether you hold gold, whether you've never thought about it, whether you're a beginner or someone who's been following markets for years, the framework here matters. Look at the flows, not just the feelings. Pay attention to what institutions are doing with actual capital, not just what the crowd is saying. Distinguish between short-term noise and long-term signal, and always consider multiple scenarios rather than betting everything on one outcome. That's the job of a thoughtful investor, not to predict the future. No one can do that. But to understand the present clearly enough to make informed, rational, calm decisions that serve your long-term financial well-being. Nothing in this video is financial advice. We're here to learn together, think more clearly about money and markets, and understand the world around us a little better. If this gave you something useful to think about, share it with someone who might benefit. Drop your thoughts in the comments. I read them, and they often shape future videos. And if you're not subscribed yet, now is a great time.